The Federal Reserve raised interest rates Wednesday to a still low range of 1.5 to 1.75%. The move signifies the Fed is sticking with a gradual but consistent approach to rate hikes under its new chairman, Jerome Powell. In a statement, Powell said the U.S. economy has become stronger in recent months, and the central bank expects the job market to remain strong as well. Jack Kramer is co-CEO of MarketSnacks. He joins us now via Skype. Right, so Jack, this move was largely expected, but data out last week showed a decline in consumer spending continued for a third month in February. Does this signify that Powell is confident in the U.S. economy?
Yes. Jerome Powell had some good news to report in his first press conference as chairman of the Federal Reserve. First of all, he upgraded the Fed's expectations of economic growth for this year and for next year, which is a good thing. And it's mostly thanks to the tax cut for both personal and corporate rates. Second, he also expects that the unemployment rate will hit 3.6% for next year. That's crazy low. We haven't had that since the Korean War. So he's actually entering the job when the economy is doing pretty darn well.
Well, what does the hike mean for the average consumer, and when will people begin to see an impact in their daily lives?
Well, the reason the hikes are happening is because for central banks, there can be too much of a good thing. Think about the situation we have right now. More people have jobs. People are being paid more. The stock market's doing very well. Housing prices are up. And this tax cut just happened. It's like a perfect storm of good things. The thing is, Americans are going to want to spend their money, and that can cause price levels in this economy to move up. That's called inflation, and one of the Fed's key goals is to keep that under control. So the Fed increased interest rates today. They expect to do it 2 more times this year and 3 more times next year. And what that means for the average consumer is that the Fed increasing the Fed funds rate pushes up the rates of all the other interest rates in the economy, including credit card rates and mortgage rates. So that's where consumers might see it the most.
Well, housing numbers also came out Wednesday, with the National Association of Realtors saying existing home sales rose 3% in February. As we enter peak home buying season, can we expect that number to rise more, even with a shortage of supply?
Oh, the shortage of supply is brutal right now. The number of available homes is at the lowest level that we've seen in years. So although new homes are being built, it's not been at a fast enough pace to take care of first home buyers. And millennials are the biggest generation in America right now. A lot of them, like yours truly, are reaching the age that we're thinking about buying our first homes, but supply is so low. So if you find the right home, you might get outbid by somebody else. So it's actually driven the average price of a new home sale up about $15,000 just in the past year to $280,000. So it's really a seller's market and a tough situation for buyers right now.
Yeah, challenging conditions for them. All right, Jack Kramer with MarketSnacks. Thanks very much, Jack.
Thank you.